Imagine turning just $10,000 into $42 million. Not over decades, not through a diversified portfolio, but in just 23 months. That's exactly what Dan Zanger did during the late 1990s tech boom. His return, more than 42,000%, was so extraordinary that it earned him a Guinness World Record for the largest percentage gain by a private investor. What makes Zanger's story even more remarkable is where he started. He wasn't a Wall Street insider. He wasn't running a hedge fund. In fact, before trading full-time, Dan was working as a pool contractor in Los Angeles. His trading education didn't come from an Ivy League classroom, but from countless hours spent studying charts, poring over technical patterns, and learning how price action reflects the psychology of real buyers and sellers. By the time the dot-com bubble began to inflate, Zanger had developed a unique edge, the ability to identify powerful chart patterns that signaled where institutional money was flowing. His skill caught the attention of major publications like Barron's and Forbes, but the foundation of his success came down to a handful of high-probability setups that he used again and again. And that's what we're going to explore in this video. We'll break down the 3 chart patterns that became central to Dan Zanger's legendary run. Not just the shapes on a chart, but the meaning behind them. We'll talk about the psychology, the supply and demand dynamics, and real examples that show how these patterns played out in the real market.
One of the most reliable and recognizable patterns Dan Zanger used throughout his career is the cup and handle. At first glance, it looks simple. A rounded bottom, followed by a short pullback. But behind that simplicity lies a deep story about market psychology, supply and demand, and the tug-of-war between buyers and sellers. The anatomy of the pattern. Here's how it usually unfolds. A stock goes on a sharp rally, then begins to pull back and form a rounded base. That's the cup. As the price works its way back up toward prior highs, it often stalls. Why? Because traders who bought at those previous highs are eager to sell once they're back to break even, creating resistance. Next comes the handle. This is a short, sideways or slightly downward consolidation. It's the market's way of shaking out weak hands, those who can't handle even minor pullbacks. Finally, when the stock breaks out above the handle with heavy volume, it signals that institutional buyers have absorbed supply and are ready to push the stock into a new leg higher. The psychology behind it. The cup and handle is not just a pretty chart shape, it's a reflection of real human behavior. In the cup, you see early buyers who got trapped at the highs. As price recovers, they sell into rallies to get out even, creating resistance. The handle is the moment where uncertainty flushes out impatient traders. Once that weak supply is gone, demand takes control, and the breakout often leads to powerful moves.
A textbook example of this pattern appeared in Qualcomm, QCOM, back in 1999, right in the middle of the dot-com boom. As you can see on the chart, Qualcomm had already staged an incredible rally earlier in the year. Then around May and June, it began to round out into a classic cup formation. Prices pulled back, built that smooth base, and then crept back toward prior highs. But instead of blasting straight through, Qualcomm paused. For several sessions, the stock drifted sideways. That was the handle taking shape. This brief consolidation shook out the short-term traders and built the perfect launching pad. Then came the breakout. Qualcomm surged above the handle on heavy volume, and the result was extraordinary. The stock skyrocketed more than 550% over the next 7 months. This is exactly the kind of setup Dan Zanger trained himself to recognize. He knew it wasn't the curve of the cup or the angle of the handle that mattered most, it was the psychology behind the pattern. It showed him where sellers were exhausted and where powerful buyers were ready to take over. Key takeaway. The cup and handle teaches us that chart patterns are not random drawings. They're visual footprints of supply and demand.
They tell a story of weak hands being forced out and strong hands stepping in. That's why Zanger trusted this setup so much. It gave him confidence that when the breakout came, it was backed by real conviction. And while the cup and handle is about accumulation and controlled consolidation, sometimes the market doesn't consolidate for long at all. Sometimes a stock surges so violently that it only needs the briefest pause before taking off again. That brings us to the second pattern Dan Zanger loved, the explosive high tight flag.
If the cup and handle is about patience and controlled accumulation, the high tight flag is the complete opposite. It's the market on steroids, raw momentum compressed into a tiny window of time. This is one of the rarest and most explosive patterns Dan Zanger ever traded, and it was responsible for some of the biggest windfalls of his career. The anatomy of the pattern. The rules are straightforward but extreme. First, the stock must double or more within roughly 8 weeks. That kind of move alone eliminates 99% of ordinary stocks. After that surge, instead of crashing back down, the stock pulls back only 10 to 25%, forming a short, tight consolidation that looks like a flag hanging off a steep pole. If the stock then breaks out of this flag with heavy volume, history shows it can launch into yet another doubling move. In other words, the high tight flag is not just strength, it's super strength. It signals that a company is in such high demand that even after doubling in weeks, buyers are still lined up to own more. The psychology behind it. Think about what's happening here. A stock doubles in 2 months. Most traders expect a nasty correction, but instead the pullback is shallow and brief. That tells you institutions are not selling. They're sitting tight, absorbing every share that comes to market. The flag is essentially a rest stop in a marathon rally, a moment when the market catches its breath before sprinting again.
If you want to see what a high tight flag looks like in real life, look no further than Monster Beverage, MNST, in the early 2000s. Long before it became a household name, the company's energy drinks were exploding in popularity, and the stock reflected that demand. In late 2003, MNST shares rocketed more than 100% within just a few months, a textbook vertical surge. Then came the flag, a tight, controlled consolidation of about 20%, with volume drying up as sellers disappeared. It looked like the stock was simply catching its breath. For traders like Dan Zanger, this was the setup he lived for. The explosive pull showed massive institutional appetite. The shallow pullback told him that buyers were still in control. And when MNST finally broke out of that flag on heavy volume, it launched another huge leg higher. Over just the next 2 years, Monster became one of the strongest stocks in the entire market, surging more than 4,500% and rewarding early pattern spotters with life-changing gains. Key takeaway: the high tight flag is rare. You won't see it every month or even every year, but when it does appear, it often marks the birth of a monster stock, the kind that can transform a portfolio. The risk is higher because you're buying into extreme momentum, but so is the potential reward. That's why Zanger loved it. He didn't just trade it, he bet big when he saw one form, and history rewarded him. But not every powerful setup is about speed and vertical moves. Sometimes the market builds pressure slowly, squeezing price into a tighter and tighter range until it finally explodes. And that brings us to the third pattern in Dan Zanger's toolkit, the ascending triangle.
If the high tight flag is the market's version of a lightning strike, then the ascending triangle is more like a compression spring, quiet, controlled, but loaded with potential energy. It's one of the most reliable continuation patterns in technical analysis, and Dan Zanger used it repeatedly to ride some of the strongest leaders of the late 90s bull market. The structure is simple but powerful. At the top, you have a horizontal ceiling, a price level where sellers consistently step in. But unlike a double top or distribution, the lows don't stay flat. Instead, each pullback bottoms higher than the last, forming a rising support line. In other words, buyers keep getting more aggressive, stepping up earlier each time, while sellers at resistance get chipped away little by little.
Eventually, the supply sitting at that ceiling gets fully absorbed. When the breakout comes, ideally on surging volume, it often triggers a powerful trend leg as trapped shorts scramble and momentum traders pile in. One of the most striking ascending triangles in recent years appeared in Tesla, TSLA, during the back half of 2020, right as the company was cementing its place as the undisputed leader of the EV revolution. After a blistering run in the summer, TSLA stalled under the 160 to 165 zone. That price acted like a ceiling. Every time shares approached it, sellers pushed them back. On the surface, it looked like resistance was too strong, but under the hood, something very different was happening. Each dip after ejection didn't fall as far as the last. First $110, then $121, then closer to $129. The lows kept rising, forming a clean ascending trend line. That was the tell. Institutions weren't waiting for a deep pullback. They were stepping in earlier, scooping up shares at progressively higher prices. Volume confirmed the story. On down days, activity dried up. Sellers were simply running out of supply. But whenever TSLA rallied into resistance, volume swelled, showing conviction from the buy side. By November, the pattern had matured into a textbook ascending triangle: flat resistance at the top, rising support at the bottom, tightening price action in between. Then came the breakout. As TSLA punched through $165 with explosive volume, the spring uncoiled. In just weeks, the stock surged above $300, rewarding traders who recognized the setup with a massive low-risk gain.
Tesla's 2020 triangle wasn't just a technical curiosity, it was a window into market psychology. The flat ceiling represented a wall of supply, perhaps early investors taking profits, but the rising floor showed that demand was overwhelming that supply. Each rally attempt chipped away at the ceiling until there was nothing left to hold the stock down. For traders like Dan Zanger, that's the sweet spot. A clear entry above resistance, tight risk defined by the support line, and the potential for outsized gains once the breakout unfolds. The ascending triangle is less flashy than the high-tight flag, but in many ways, it's more dependable. Think of it as the market loading a spring. The longer and tighter the pattern builds, the more explosive the eventual breakout can be. For traders, it offers a cleaner setup with more defined risk. Entries on the breakout, with stops just below support.
So let's bring it all together. The cup and handle shows us how a market digests a rally, shakes out weak holders, and then breaks free once real demand steps in. The high-tight flag is different. It's lightning in a bottle, rare, explosive, and usually reserved for the strongest stocks in the market. And the ascending triangle? That's the slow burn, a steady buildup of pressure, higher lows pressing against resistance until the breakout becomes almost inevitable. But here's the real lesson. Dan Zanger didn't succeed because he memorized patterns. He succeeded because he understood the story behind the chart. Every base, every pullback, every breakout, it's all a reflection of supply and demand, fear and greed, buyers and sellers. If you want to trade like him, don't just see shapes. See the psychology driving them. If you found this breakdown valuable, hit that like button, subscribe for more trading insights, and let me know in the comments which of these patterns you've traded before. Until next time, trade smart and stay disciplined.